It's Friday, 9th of May, and this is your Capital Economics Weekly Briefing. I'm David Wilder. I'm joined by Neil Shearing, our Group Chief Economist, and by Julian Evans-Pritchard, who is our Head of China Economics. And we're going to run through another action-packed week in macro and markets and look ahead to the coming 5 trading days. Hi, Julian. Hi, Neil.
Hi, David.
Hi, David.
Neil, we all saw the white smoke yesterday signaling a US trade deal with the UK. I call it a deal, but actually it is a non-legally binding document defining the general terms of an economic prosperity deal.
That rolls off the tongue, doesn't it?
It really does, doesn't it? I mean, what does this all tell us about the way forward in terms of finding the quote-unquote off-ramps from Trump's tariff policy?
There's a couple of points I think that are worth stressing. One is that slightly garbled title tells you something, actually, which is that a full trade agreement is going to be impossible to do, not least because the president doesn't have authority to do it. The authority for trade agreements rests with Congress. Hence, we end up with these kind of memorandums of understanding, for want of a better term. And so anyone expecting full trade agreements with a raft of different countries over the coming months and quarters, I think, is going to be disappointed. So this does, I think, in some senses provide a bit of a blueprint for others to follow, insofar as it will be a memorandum of understanding, an agreement of sorts. So that's the first point. The second point is when we look at the detail, actually, of this so-called agreement, despite the president's claim that it's full and comprehensive, actually it's no such thing. There's a bit of an agreement to roll back some tariffs on the first 100,000 cars exported from the UK to the US. There's a bit of improved market access for UK farmers in the US and US farmers in the UK. But to coin a term, this is a bit of a nothing burger, I think. This is certainly not a full and comprehensive deal. And the third point I think that's perhaps worth stressing is that the 10% baseline tariff has stayed in place. So despite the fact that the UK government's heralded this as a big win, the US, of course, is heralding it as a win, the 10% tariff has stayed in place. So I think that might suggest that other such deals, such as they can be called deals, when they are struck, the 10% baseline tariff will stay. Now, for the UK, that's not a big deal because it doesn't export a vast amount to the US anyway, and it's managed to agree some carve-outs for cars, as I say, steel, aluminum, a bit of market access for agriculture. It's probably the best the UK could have hoped for, and the 10% tariff, while unhelpful, is not the end of the world. But the US is a major export market for some economies, and a 10% tariff will have a more meaningful impact if that is to stay. A bit of a nothing burger, but perhaps something to be read into the fact that the 10% baseline tariff has stayed in place, and I suspect that will happen for other countries too.
Yeah, it's probably worth mentioning Trump was asked about the 10% yesterday in the Oval Office. He said that it was the UK got a good deal and that the 10% was the low rate. But quoting directly from our chief US economist, Paul Ashworth, who said all of this reveals that there's rising desperation within the administration to roll back tariffs before they hit US GDP growth and inflation. That's really what's driving this process now, isn't it?
I think so. I think there's a sense in which some within the administration that are perhaps the less hawkish end on trade, so particularly Scott Bessent, they're in the ascendancy. It was clearly the case that the cracks that started to emerge in the bond market at the start of April after those Liberation Day tariffs, particularly at the long end of the curve, I think that spooked a number in the administration, particularly the Treasury. And there's now an effort to row back from those kind of extremely hawkish positions on trade and tariffs. But I don't think we're going to get all the way back to where we were at the start of this year. It's pretty clear that, yes, there's an effort to row back from the really extreme tariff rates that were announced back at the start of April. And I don't think we'll see those being implemented. Julian will say more on China. China might be an exception where tariffs end up at a slightly higher rate. But in general, I think 10% is a kind of reasonable baseline for most countries still. But 10% is still higher than the 2.5% average tariff rate that the US imposed at the start of this year. And you can cut it both ways, really. We're not going to go back to those April the 2nd tariffs, I don't think, because of all the reasons that Paul suggests. But equally, we're not going back to the tariff rates that we had at the start of the year because it's pretty clear that the administration views this as a source of permanent government revenue, federal government revenue, that it can use to cut taxes elsewhere.
Julian, let's bring you in at this point. We've got these talks in Switzerland this weekend, Scott Bessent and He Lifeng meeting market expectations are high coming off the back of this UK-US trade deal, whatever we want to call it. But are expectations too high?
As both you and Neil said, there's clearly a desire in the Trump administration to bring tariff rates back down. And Trump has repeatedly said that tariffs on China are not going to remain at current levels. So I do think that they will probably be willing to accept relatively limited concessions from China in return for bringing those tariffs back down to some degree. But I do think that for the wider sort of geopolitical reasons, China is going to remain one of the primary targets of Trump tariffs. The suggestions that are going around, we had a New York Post story overnight which suggested that they're considering bringing tariff rates back to around 50%, which would be close to our base case scenario in which tariffs on China end up at 60%. So that's the kind of ballpark range we're probably looking at. In terms of how we get there, I think the sort of things that the US is looking for is greater cooperation from the Chinese on fentanyl flows into the US, particularly the precursor chemicals that are used to produce fentanyl. There's also reports that the US would like China to roll back some of its export controls on rare earth metals. And of course, the US wants to see China reverse its retaliatory tariffs that it imposed following Liberation Day. So I think those are areas where certainly the Chinese will be willing to at least consider making those kind of concessions if it means that they're subject to a lower US tariff rate. But I don't think we should expect anything too substantive beyond that. We've seen already with the US-UK deal, as Neil said, that was really largely a nothing burger. I think the same largely applies to what's going to happen between the US and China. Obviously, in the case of US and China, there is a lot more trade, so the tariff rates are quite important. But beyond just reversing some of the tariffs, I don't think we should expect too much in terms of a wider sort of substantive agreement between the two countries.
Okay, so a bit of de-escalation, but no fundamental fixes. I mean, you talk about tariffs ending up in the range of 60%, maybe a bit lower than that. But in terms of the impact on China's economy, what does this all mean?
Well, I think the impact could be less severe than many people expect, particularly if tariff rates do come back down to around 60%. And that's because, as we're already seeing from today's trade data, there's a lot of ways in which the impact of tariffs can be absorbed, both through the exchange rate. Now, if you look at the renminbi against the dollar, it hasn't actually weakened since the Liberation Day tariffs. But if you look at it in trade-weighted terms, it is actually down over 4%. And you have to remember that exchange rate move applies to China's entire export basket, not just exports going to the US. That alone is probably equivalent to offsetting a US tariff of around 25%. And then you have the additional offset through rerouting and transshipment. One of the sort of big themes in the trade data that we got today is that we saw a sharp fall in exports to the US, down around 20% year on year, but we also saw a big jump in exports to neighboring countries, particularly in ASEAN and Mexico. And we saw that pattern during the first trade war, where a lot of these exports that previously went directly to the US now are going indirectly through third countries, and that significantly dampens the impact on China's own economy. So given those two offsets, we're looking at a hit to GDP in the range of around 0.5% if tariff rates come down to 60%. If they were to remain at current levels, then the hit would be significantly larger, we think, at around 1.5%.
I think that point about rerouting is a really interesting one. It's striking that we're seeing it in the data so quickly. I guess one question I have in my mind is, if you're Mexico and if you're, say, Vietnam, clearly they turn themselves into, in some senses, into centers for transshipment of Chinese goods into the US through the back door, avoiding tariffs in 2018, 2019. And that seems to be what's happening again and playing out again in 2025. But I wonder the extent to which they're willing to continue to allow that to happen, because it's pretty clear that if you're going to run very large trade surpluses with the US as a result, then you're going to find yourself quite quickly in the firing line from the Trump administration, aren't you, this time around, particularly in the context of USMCA being renegotiated later this year, potentially rules of origin within that agreement being tightened. So I wonder, Julian, what's your take? Do you think that's going to continue? I wonder what the extent to which, if I was sat in government in Mexico City, I'd be thinking, actually, do we want to stop this? Do we want to push back against this? Because otherwise we're just going to find that actual production and value added in Mexico is just going to be tariffed, and the same is true of Vietnam.
I do think they will go to greater lengths than they did during the first trade war to try and prevent some of the sort of vanilla rerouting where goods are simply coming through the country without really any additional value added taking place in the country. And I know that Vietnam has already made some kind of agreement with the US to try to clamp down on transshipment. And certainly the threat of additional US tariffs will, I think, encourage regulators in these countries to pay closer attention to these flows. But I do think it's quite difficult to prevent trade flows from adjusting in a broader sense. Even if you restrict outright rerouting, there's still a very large incentive for companies to import inputs from China, assemble them in a third country, and then ship them to the US. And that's also in the interest of those countries themselves because it means they capture greater market share globally in terms of manufacturing value added. So I think these countries are in a very difficult position. The US has been putting pressure on them to try to reduce the inflow of goods into those countries from China. But I think they're very reluctant to actually go the full way and impose their own tariffs on imported inputs from China because they're so crucial as parts of their own internal manufacturing sector. So, yes, I think there will be some effort to crack down on this, but I think we're still likely to see quite substantial rerouting or at least offshoring of some final stages of production to these countries, with a lot of the value added still actually taking place in China.
I wanted to stay on China, Julian, because with all that you've said there about the impact of all of this trade war on China isn't as big as most people would seem to think in terms of the direct impact on China's economic health. And I think that it is important to remember, this actually does come in through your analysis, that it's just the trade war is just another headwind for an economy that's already been struggling. So just for the purposes of listeners, just map out how we see Chinese growth panning out over the coming few months.
So I think it's important to keep in mind that the US tariffs are not the only headwind facing China's export sector. I think a bigger challenge will simply just be sustaining the rapid gains in global market share that we've seen in recent years. And that's really what's been the engine behind China's booming export sector since the start of the pandemic. And I think a lot of it comes back down to the pandemic itself and the impact that it had on inflation in China, where it didn't increase inflation at all, and outside of China, where it did. And as a result of that, you've had this shift in the relative price level between China and the rest of the world. And this large wedge has opened up between export prices from China versus export prices to the rest of the world, around 20% gap that didn't used to be there. And that's really allowed Chinese exporters to gain competitiveness relative to the rest of the world. And that's what's been fueling this export boom. But that's very much a one-off gain in competitiveness. The pandemic hopefully is not going to happen every few years. And so it's going to become a lot harder for Chinese exporters to continue to gain global market share at the pace that we have seen in recent years. And as a result of that, I think export growth is likely to slow regardless of what happens to US tariffs. So even if US tariffs were to come down all the way, which we don't think they will. So any US tariffs that do remain in place, we think will just be an additional drag on top of these wider headwinds facing the export sector. So we're likely to see export growth slow quite substantially over the next couple of years. And that really leaves policymakers in a difficult position because it means they have to step in much more forcefully to offset that through greater domestic demand. We are starting to see that to some degree. We had a much looser budget announced back in March, a fiscal expansion of about 1.5% of GDP. The problem, though, is that private demand in China is continuing to weaken. And so this fiscal impulse doesn't seem to be enough to really ensure that the economy is regaining momentum even before US tariffs come into force and we see the full impact of those tariffs. So during the first quarter, on paper, official GDP growth suggests the economy continued to grow quite strongly, above 5% growth. But our own in-house China activity proxy shows that growth actually continued to slow in the first quarter to just 3.9%. So the economy not looking in that great shape, even before we see the impact of US tariffs, and even with that increased fiscal support. So our sense is that probably they will have to announce a greater stimulus in order to prevent growth from slowing too sharply this year. And even with the stimulus that we have so far, I think growth, in our view, could slow to as low as 3.5% for the year as a whole.
On stimulus, I mean, does that include monetary stimulus? We had the rate cuts, reserve requirement cuts earlier in the week. Would we expect more on that front? Is that part of the armory for keeping the economy on track?
Well, it certainly helps at the margin. It takes a bit of pressure off of indebted firms, reduces their interest costs. But I don't think it really delivers the same kind of boost to economic activity that we have seen in the past during previous rounds of monetary easing. And that's because the private sector and the household sector is just not that interested in borrowing more. The sentiment is very weak. Credit demand has become very insensitive, partly because asset prices are declining. And so we've seen it already in the past couple of years that interest rate cuts just don't really deliver much of a pickup in credit growth or any wider economic activity. And I think that will remain the case over the next couple of years. And that does really mean that it falls to fiscal policy to do the heavy lifting in terms of supporting the economy, which is why I think really the focus needs to be on whether we see a further expansion in fiscal policy later this year, which is possible. It's something that the authorities have done occasionally in previous years, and it's something that they've flagged as a possibility over the rest of this year as well.
All feels a bit stopgap, though, doesn't it? And we've been talking time immemorial about this need for economic rebalancing, for structural reform within China. Surely the internal debate is moving in that direction at this point.
They're certainly saying the right things in terms of rebalancing the economy towards consumption. They've made boosting consumption their top priority officially for this year. Unfortunately, though, they don't seem to really be backing that up with many concrete actions. The only sort of substantive measure that they've taken to boost consumption this year is to increase the consumer goods trade-in scheme, the quotas for the subsidies for that scheme from 150 billion yuan to 300 billion yuan. And that's pretty small change in the context of the Chinese economy. It's less than 0.2% of GDP. And the other problem with these subsidies is that they are one-off, and they essentially just encourage consumers to buy certain products, but they don't really change the overall savings behavior of the households. And that's the fundamental problem holding back rebalancing, is that Chinese households simply save way too much compared to households in the rest of the world. And that's something that the government is not really addressing. Instead, that the bulk of fiscal spending this year is still being targeted towards investment rather than consumption.
Neil, Julian's talked about China's situation, but the other big player in this global tariff issue is the EU. Trump's called the EU very nasty, but then this week reportedly called Ursula von der Leyen fantastic. Make of that what you will. But the UK deal, it was fairly straightforward, wasn't it? I presume with the EU, it won't be as easy to get that off the ground.
I think that's exactly right. Yes, the deal with the UK should, on paper at least, have been the easiest one to have done. The UK, of course, staunch US ally. It runs a small trade deficit in goods with the US, so it's not really in Trump's firing line when it comes to running a large surplus. And frankly, the UK is not a major economic player on the global stage, whereas Europe's in a different position. Bigger bloc, sometimes struggles to speak with one voice. It's got to coordinate policy across 27 countries when it comes to trade. And of course, it runs an enormous goods trade surplus with the US. So it will find itself in the crosshairs when it comes to Trump's tirades around trade and tariffs. So it's going to be much more difficult, I think, for the European Union to do a deal with the US. Now, that's not to say that there won't be some kind of deal. It won't happen. I just think it will take longer to materialize. And of course, we've had over the past few days briefings from the EU about goods from the US that they will impose tariffs upon if a deal is not struck. Boeing has been cited potentially. They also left the door open, interestingly, to restrictions on US services, which would be a much bigger deal for the US given its large surplus in service exports. So it's going to be much more difficult to reach a deal with the EU. Both sides, I think, still want one. It's clear from the briefings over the past week or so that both sides still want one. It's notable, too, that the EU has not gone in their words dollar for dollar in terms of planned retaliation against US tariffs. But I think getting a pathway to a deal will be harder to find with the EU, take a bit longer than was the case with the UK.
The clock's ticking down to July the 8th, isn't it? And that's when this 90-day pause on these reciprocal tariffs expires. What do you think the world's going to look like when we get to July the 9th, given all of the deals still to be done? You talked about the difficulty with the EU, maybe some countries harder than others. But obviously, as we mentioned, we do see desperation within the White House to get these things over the line because of the threat to the US economy. So what does it all look like when we get to July 9th, and what does it mean for the global economy?
Honestly, I don't think anybody knows. And anybody that tells you that they know is being disingenuous. I think that's the first point. If I was to bet, my hunch is that what will happen is we'll get to July the 7th. Some deals will be done that look a bit like the deal that was struck with the UK, as in essentially keeping a 10% baseline tariff and reducing tariffs elsewhere. But many will not be done. It's going to be difficult to conclude deals with 100 plus countries in what is now less than 2 months. So my hunch is that 90-day extension will simply get rolled over. Trump will claim victory, say that he's done some great deals. He needs more time to do even more great deals for the American people and the American economy. Roll it over for another 90 days. And in some senses, we're going to end up with this extension being, I think, rolled over in perpetuity, such that a reasonable assumption, I think, is that most countries end up facing a 10% tariff on their exports into the US. And China, as we've discussed earlier with Julian, will I suspect have a higher tariff rate, but not quite as high as it is right now.
But the uncertainty doesn't really go away because you've still got, highly erratic decision maker in the White House. And so any agreement could come under threat just via a social media post.
Yes, of course, that's correct. To some extent, I think what matters is the degree to which Trump simply gets bored with this subject, that he decides that he's taken big actions in the first 100 days. He's done these terrific deals. He needs a bit more time to do even more terrific deals. That gets rolled over. And that by the time we move into the second half of this year, attention shifts elsewhere. Maybe it's onto immigration, or there's some big tax and spending bills to pass through Congress. Maybe attention starts to shift in that direction. So you're right that there is inherent volatility in policymaking. The temperament of the president does not lend itself to stability, but it's possible that he simply claims to win on trade and tariffs and moves on to something else, in which case the world will move on too. I think that's a possibility as the rest of this year unfolds as well.
Okay, let's go back to Europe, talk more generally about the outlook there, because Friedrich Merz finally became the German Chancellor this week, the new Chancellor, albeit after a rocky start, but it's part of this more general turnaround in European sentiment that we've seen in recent months. At the start of the year, it was all doom and gloom, peak Euro pessimism. Now there's a lot more optimism about the Europe outlook. And I was hoping you could just talk a bit about what's driven this shift.
Yes, to some extent, I think it depends a bit whether your glass is half full or half empty. The context, of course, is the fact that Europe in general has had a pretty torrid 3, 4, 5 years since the pandemic, and then the energy shock that followed Russia's war in Ukraine. Germany, in particular, the largest economy in the Eurozone, having a really bad time of it, as effectively the economy the same size today as it was 5 years ago. So 5 years of lost growth, of stagnation. So the question is the next 5 years going to look as bad? And I think the answer is no, it's not, for a couple of reasons. One is that the headwinds that contributed towards the period of extreme weakness in recent years, I think, have eased. Inflation's down, the ECB's loosening policy has got a bit more policy easing to come. I think the terms of trade shock from the surge in energy prices has worked its way through. And of course, in Germany, we've got the fiscal relaxation coming, so that the government taking a far more permissive approach towards fiscal policy, the fiscal straitjacket, as it were, being loosened, more money on defense, more money on capital investment, public investment, and that boosting demand in, as I say, the region's largest economy. So all of that comes together. And despite the tariff threat, I think the economic outlook for Europe over the next few years looks better than in the past few years. Now, the question is, does all of that mean that this gap in performance with the US has been eradicated? And I think the answer to that is, despite the fact that the US itself is facing headwinds, no, it's not. The US, I think, over the next 3 or 4 years will continue to outperform Europe, but the degree of outperformance will be substantially diminished compared to the past 3 or 4 years. Now, all of this we're going to be exploring in a major piece of work that we're publishing over the next week or so, the Future of Europe series, a series of big focus pieces, podcasts, online briefings, drop-ins. We're holding an in-person event in London, for which I think at the time we're speaking, there's 1 or 2 places left, so sign up on the website if you're interested in attending. But yeah, as I say, the outlook's brightening, but working out the extent to which it's brightening and the sectors for where the outlook's brightening is going to be critical to navigating the path ahead, exploiting those opportunities.
Fantastic plug. Let me finish. Julian's had to go off for a meeting, but let me finish by asking you this question. Chinese state media this past week has been extolling 50 years of diplomatic ties between China and the EU. And clearly, some in Beijing see there's an opportunity in Trump land to forge closer relations with the EU, pull the EU out of the US orbit. How far do you think that process goes?
An opportunity, yes, but I think it's going to be quite difficult to fully exploit that opportunity for a couple of reasons. Let's start with what's driving this. It's pretty clear that in response to broadsides from Trump, the EU has taken a more independent position from the US in several areas, particularly defense and security, right? So it's going to have to assume greater responsibility for regional defense and security. But I don't think there's going to be a hard economic break from the US. Not least because the degree of trade ties, financial ties across the Atlantic is so deep. Those ties run so deep. And of course, you have social, historical, cultural ties too. Severing those and Trump essentially driving the EU into Beijing's arms, as it were, I think it's going to be quite difficult to do. I don't think that's plausible. I think at the same time, it's worth noting that many within Europe are becoming increasingly cautious with regards to relations with China, and for a couple of reasons. One is because some governments are starting to share America's concerns with regard to national security, supply chain security, and the risks to that of becoming deeply enmeshed with China, particularly affecting areas of high tech. But also there's just a simple economic issue and trade issue here, which is that, as Julian was saying, Chinese exporters are extremely efficient, extremely competitive. And if they're closed out of US or shut out of US markets because of tariffs, then what will happen is they'll seek new markets. And the most obvious place to look for those is in the large emerging economies and in Europe. So there's a danger, I think, that one consequence of the imposition of US tariffs on imports from China is that it pushes Chinese exports into other markets, and that in time, governments in those markets, particularly in Europe, start to push back. So it's possible that, because they're concerned about the impact on domestic producers and so on and so forth, so it's possible that the next leg to drop into this trade war, as it were, is that the governments elsewhere in the world start to push back against the large influx of imports from China that's directed to their countries in response to the US tariffs. So I think I pour a little cold water on the idea that in response to Trump, the transatlantic alliance is completely dead. Europe's going to reorientate itself towards Beijing. Europe will become a bit more independent from the US in some areas, but fundamentally, I think wind the clock forward 5-10 years, Europe will still be an ally of the US, I suspect.
Neil Shearing and Julian Evans-Pritchard there on trade deals that really aren't deals, China's economic struggles, and the future of Europe. As Neil mentioned, our project on the future of Europe starts this coming Monday and includes a stream of in-depth reports, online briefings, and in-person meetings. We'll also be on this podcast exploring some of the themes that are raised in the work. The work itself includes analysis on how much Germany's outlook has changed, how far increased spending can go given the region's fiscal vulnerabilities, how far the EU can expand, the UK's relations with Europe, and of course whether the reallocation towards Europe that we've seen in financial markets is sustainable. There is a landing page where we'll gather all the work as it's published. I will stick that in the podcast notes. It also has details of our London event. If you are in town this Wednesday, 14th of May, then do come along, hear from the team about the work, and get together with other capital economics clients. Of course, we're going to be tracking the weekend's US-China talks very closely. We will bring you instant analysis of that as news develops. Given that US tariff rates on China are in flux, remember you can always model different tariff rates and see how they affect GDP with our tariff impact model. That's one in our growing suite of data tools, and I will add a link to that in the podcast notes as well. I also want to flag a China labor market indicator that Julian and the team have launched this past week. It's another interactive data dashboard that's designed to cut through the fog of official Chinese employment data, give you a much more accurate picture of how labor conditions are holding up in the face of all of those headwinds that Julian described. I will add that to the podcast notes as well. Remember, you can get access to all of our analysis, our suite of data tools, our tools to engage directly with our Economist team with our all-access packages. CE Essential and CE Advanced are designed to give time-starved, information-overloaded decision makers the insight they need so they can work more effectively. Get in touch via sales@capitaleconomics.com and get set up today. But that's it for this week. We will be back next Friday with more on global macro and markets, including reviews of any more successful trade deals, or as they're technically known, non-legally binding documents defining the general terms of an economic prosperity deal. Until then, goodbye.